charts might just be the best thing since sliced bread. If you're a dividend investor and you want to be able to effectively pick your entry points and your exit points of dividend stocks, DFT charts will make your life a hell of a lot easier. I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe, a membership which allows you to receive all of our analysis of our universe of 120 hand-picked dividend stocks with buy below prices, sell above targets, free model portfolios, buy lists, watch lists, sell lists, a community, a live chat, which we sell through Seeking Alpha. Today we'll be taking a look at our proprietary DFT charts. This is what they look like. Let me just move myself to the side. This is what a DFT chart looks like here. These fancy little charts which show you when a stock is historically overvalued or undervalued relative to its dividend yield. But we're getting ahead of ourselves. So how does all of this work? Let's say you've got a stock which pays a fixed dividend. And this is a stock price going up and down over time. And this is the price level at which it yields 3%. And this is the price level at which it yields 5%. Anyone who's looking at this stock, and anyone who's been looking at dividend stocks for a while, has many of these types of observations, will think, well, when this stock is yielding 5% or more, it's looking undervalued, and when it's getting towards 3%, it's starting to get overvalued. Sure, I could hold it throughout and receive the dividends, or I could buy at 5%, sell when it yields 3%, and repeat. This is why you might see people say things like Pfizer is a total bargain when it yields more than 5%, or conversely, when any time Pfizer goes above 2.5%, it's a good idea to sell. Right, this is with fixed dividends. But when we're talking about dividend growth stocks, we're often talking about stocks which grow their dividend year in and year out. So this changes the dynamic a little bit, right? Because the price level at which a stock yields 3% goes up in lockstep with the dividend increases. So here it's showing just a straight line, but in practice we can imagine that it would be a jagged line that goes up over time. Nonetheless, the concept still applies, right? Here the stock is still relatively overvalued when it yields more than 3%, less than 3%, and relatively undervalued when it yields more than 5%. The only difference here is that because of the dividends increasing over time, which in a healthy company would reflect the fact that cash flows are increasing over time, which are enabling the company to pay out more in dividends, well, what we realize quite easily here is that a price at which a stock might be overvalued at one point in time might be the price at which it will be undervalued in the future once the dividend has increased significantly. So this is a powerful insight which we can use, knowing that stocks tend to trade within a given range of yields. And while these ranges might change over time, what we found is that there's usually a reversion towards the mean. Not all the time, but enough that we can use this insight as a way to choose attractive entry positions into a stock and out of a stock. Now let's look at how we build this with an actual stock. We take all the prices over the past 10 years and the dividend information over the past 10 years. These small grey bars, which you see here on the charts, show the dividends, and as you can see, they go up over time. Then we'd infer at which price the stock would have traded if it traded at its minimum yield over the past 10 years, or when it was the most overvalued relative to its dividend, at its maximum yield when it was the most undervalued relative to its dividend, and then we'd look at the numbers in between, like what was the median yield over that period. So the median would be the yield at which the stock either traded above that level 50% of the time or below that level the other 50%. And then we'd fit in with here the 25th percentile and 75th percentile, which would be the lines here you see going between the red and the pink on the screen, as well as the light blue and the deep blue. This way, we can easily tell us, okay, the core 50% of the time, a stock is trading in this light pink to light blue range. The 25% of the time when it's the most undervalued, it's in this deep blue range. Conversely, when it's the most overvalued, it's in this deep red range, right? And then all that's left is, that's great, that's a rear view vision, is to see and have an idea for where the dividend is and the stock price could be headed over upcoming years. And so what we do here is we look at the lowest of the 1-year dividend growth rate, the 3-year compound growth rate, and the 5-year compound growth rate to project growth into the future. This is a conservative way of approaching this and allows us to project without overestimating growth. We'd rather underestimate growth, be on the safer side of things, than the other way around. Right, now let's look at a few cases of Dividend Freedom Tribe charts, or DFT charts, in real time. So what we see here is we've got a chart of NextEra Energy, a utility stock. And as we can read on this little bit of the description, over the past 10 years, it has traded the core 50% of the time between 2.15% and 2.92% dividend yields. So all these areas which you see here on the chart, from the light blue to the light pink, all the way up, would be the price levels at which NextEra Energy, or NEE, would have yielded between 2.15% and 2.9%. That's usually where it trades. As you can also see, sometimes it overshoots or undershoots this quite significantly. Here we can see that NEE has yielded as little as 1.64% and as much as 3.8%. On the charts, you'd see this here, where at this time in 2020, it yielded 1.6%. Again here in 2021, it yielded 1.6%. And recently in October 2023, at the end of the most recent bear market, it yielded, 3.8%. So one might think, well, an easy way to buy is that when NextEra Energy yields more than 3%, you buy. When it yields less than, say, 2%, you sell. Doing that would have resulted in rather good results. Yes, you would have sold NextEra Energy maybe early in 2020. That would have avoided you this little crash at which you could have re-entered. Then maybe you'd have sold early here again later in 2020 or into 2021 and 2022, moving out of the position, only to then be able to re-enter within the last 6 months. So this shows sort of the power, especially with stocks which have consistent dividend growth rates, which is the case with NextEra Energy. Last year, the dividend increased by 10%. During the past 5 years, the dividend has compounded at a 10% growth rate, and over the past 10 years, it's compounded at 11% growth rate. This is very tight. We know that NextEra Energy will likely continue to grow at this rate or slightly slower, and this gives us a good indication of when a nice entry point is into NextEra Energy. Let's look at a few more charts and see what information and how we can really derive value and understanding just from these charts with a bit of real-world context. Let's take IBM here. So IBM is a stock which topped out in 2014 and before entering what was nearly a decade of lower stock prices. And the reason behind this is that, let's say, from before I was born until halfway through the past decade, IBM was viewed as a growth stock. And all of a sudden, this growth came to a halt. It was viewed as this sluggish, big mega corporation, which has since, by the way, gone through multiple spin-offs, multiple acquisitions, the Red Hat acquisition. They finally kicked out a few years ago that CEO, which was just no good for the company, and things have started to turn around. Nonetheless, what we saw is that as IBM became a more sluggish company, the stock price shot down and kept going to newer lows relative to the dividend. And what was this telling us? And you can see here, in the first part of the past 10 years, there was still some dividend growth that was quite nice, as you can see. Then in the second half, this has gotten a lot slower, with a small resurgence here, but generally speaking, it's bumping along. So what has happened is that during the period between, say, 2015 and 2023, because things have started to change for IBM, the market viewed IBM as sluggish and therefore required a higher dividend yield from the stock. So an investor who in 2018 would have said IBM is a good buy relative to its history would only be taking a rear view mirror look and would have to take more into context. And as you see here, would have suffered a couple more years of losses and the stock going nowhere before it's moving on. Now, this is why you actually need to know what you're doing, and just using a chart isn't enough. We were well aware of the transition that IBM was going through between 2017, 2019, 2020. And if you look at our track record on Seeking Alpha, let me just move myself out of the way again. We said June 2017, don't let IBM's cloud growth cloud your vision. In September 2019, IBM didn't like it then, still not a fan. In April 2020, finally a good time to buy IBM. And in August 2020, the 5% yield blue chip you'll regret not buying in 5 years. So these are articles which we had published on at the time, and as you can see, since these recommendations, IBM is up 95%. Actually, you can't see that. Let me move myself out of the way. IBM has returned a total of 95%, whereas the S&P 500 has only returned 54%. So not bad. But what does this show you is that it shows you that if you can use the DFT chart as a tool to enter positions and then follow it up with high quality equity analysis, you'll have the edge you need to get the returns from your dividend positions that you want. Now, from 2020, it's been an easy ride. We accumulated a position over the course of the year, and it was range bound for a while. And finally, in late 2023, when the market started picking up again, IBM finally got included in all the AI frenzy and craze, and the price has been bid back up all the way to $197 where it is now. Now, this is new all-time highs for IBM. We are starting to slowly load out our position, but we're well aware that as a stock reaches new time highs and has great momentum, there's much potential for it to go up, and really no saying sky could be the limit here. So we're gradually exiting the position, taking our gains off the table, and just enjoying the ride up on the rest of the stock. Now, let's look at yet more examples of DFT charts, just so you really get a feel for how good they are. Here we move to 3M, and what we realize with 3M is that we've got clearly this chart which is showing two different tails, right? As you can see, between 2014 and 2018, the stock exists in the pink and red ranges on the chart, and then thereafter, let's say from 2019 to now, it's living in the blue, light blue, and deep blue areas of the chart, which might be a case to say that the old range no longer applies to 3M, especially when we see that here we had some dividend growth, and since it's been pretty much close to zero. We can see that here numerically. Over the past 10 years, 3M's dividend has grown at 6% compound annual growth rate, but only 1% over the past 5 years, which means that most of the growth came in the early parts of that decade. Now, that means that, well, maybe the ranges of a 5-year chart would apply a lot more to 3M. And so here you can see that over the past 5 years, the dividend has yielded as little as, say, 2.6% in 2021 and as much as 7% in late 2023. Is 3M a good buy now or not? Our opinion is that it's not, and the track record is also that we exited 3M around $200. This time we got the important is to be close enough to the top when you're selling and close enough to the bottom when you're buying. I personally don't have a very positive fundamental outlook on 3M right now, so we're not recommending buying despite the signal that could come from the chart. But this is a clear indication that when you see a stock break through and build new ground to the bottom of the chart, that something might have changed fundamentally, and you'll see that with the lower dividend growth rates here, which clearly signal that the market is demanding more yield to be able to invest in 3M, likely for higher risk. So this shows a scenario where you can't just blindly count on a DFT chart because of the change in growth rates. On the flip side of things, sometimes you have stocks which grow their dividend immensely in one time. And this was the case of Dick's Sporting Goods last year in early 2023, decided to grow the dividend by 100% or something like that. They effectively doubled the dividend. And what you see here is that on the chart, this ends up pushing the ranges quite high above, and the stock ends up stuck below. This is because it takes the market quite some time to adjust upwards to these higher growth rates, which gives an interesting period of accumulation for dividend investors. And we particularly suggested that investors top up in Dick's Sporting Goods in, I believe it was August. Let me just look this up. Dick's Sporting Goods, 25th of August. What to think of Dick's Sporting Goods after the 25% drop. The conclusion was, I think DKS should be a $200 stock by 2025. I'm planning to top up my position and our position in these portfolios. Right. Dick's Sporting Goods is now at $190, up from that 110, showing once again fantastic results here. And I believe we'll continue to see it climb up higher on positive momentum and this backup pent-up value that came from the dividend here, as it's now breaking all-time highs. Another great example of this is Morgan Stanley, which also in 2021 increased the dividend, and it sort of peaked there for a while, the stock price living below, which has made Morgan Stanley one amazing investment since its peak in, say, late 2021, especially when we consider that both the wealth management and investment banking cycles are at the absolute bottom and only looking to recover from now. One final example I wanted to show in this video on DFT charts is Simon Property Group, ticker SPG, which cut temporarily its dividend during the pandemic. Mall operator, and obviously there was very little foot traffic to malls during the pandemic, which forced it to cut the dividend. And what we can clearly see is that stock prices react to these dividend cuts. And so there is a clear relationship between the dividend and the stock, provided that the dividend is a reflection of the value creation of that company over time. And here we see when SPG cut its dividend, the stock plunged. As the dividend recovered, the stock recovered. And of course, it's gone up and down based on the real estate cycle and has been doing quite well once again since the end of the bull market here in October 2023. And this gives you a clear idea of how investors can use a simple tool to help them assess when is a good entry point and when is a good exit point from stocks. Now, this doesn't mean that just because a stock is in the undervalued blue area that it's a good investment. It's clearly the case for Johnson & Johnson, which is a stock that I've grown to dislike somewhat over time. The dividend growth rates have somewhat slowed. As you can see here, it's currently yielding 2.95%, which is in the deep blue zone here. But Johnson & Johnson has been growing its dividend at 5 to 5.5% recently. If we project that 5% growth rate into the future, what we'd see is that if we invested $10,000 into Johnson & Johnson today, reinvested the dividends, then 10 years from now, we'd expect to receive about $650 in dividends, which is less than we expect from these sort of dividend investments. This will be the topic for another video. If you enjoyed this, please make sure to hit the follow button below and also to check us out on Seeking Alpha, where as a YouTube reader, we give you a better discount on your first year, so you'll probably have a better price than what you're seeing here. You get a 2-week trial, all our model portfolios, our tech tools, access to a live chat in the community, and yada, yada, yada. There's a lot there. If you're interested, check it out. Once again, I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe. Have a good day.